Welcome to Market Visions Conversations with Ramki show. This is bringing to you Ramki, who has over 25 years of experience with markets, has rich and deep knowledge of the Elliott Wave Theory. His views are sought after by leading banks and hedge fund managers all over the world, and he now runs the treasury of a bank in the Middle East. He writes at wavetimes.com. So if you're a trader, you must read wavetimes.com. And good afternoon, Ramki, and welcome to the show.
Hi, Deepak. Good afternoon, and hello, listeners, and those who are on the video as well. It's nice to be here along with Deepak to talk to you about the markets. So let's jump straight into it, Deepak. What would you like to ask me?
I'd love to ask you about everything about the Indian markets, but because we have a limited amount of time, let's take a few stocks that you said showed a lot of promise. I know that you have recently posted a view on the Nifty that talked about how the Nifty could go all the way down to 4,800, and at the upside, a rally could take it to 5.8, but that's about it. But we would love to hear about other stocks, like three in particular that we're looking at is the Bank Nifty, DLF and Tata Steel. So how do you feel about those stocks, Ramki?
All right. Let's start off with the Bank Nifty, you said?
The Bank Nifty, yes.
Let me look for it. I had to search for it because I'm not very familiar with Indian stocks as such. So what I'm going to do is search for Bank Nifty on Reuters. It's going to take a couple of seconds.
Sure, absolutely.
Oh, okay, there we are.
Brilliant. Do you want to share the screen so that...
Oh, it's not started yet? All right.
Not yet.
Okay, let me share the screen. Calls, share full screen. Okay, here we are. This is the Bank Nifty. Is this the right one, Deepak?
That should be the one. That's 10,000 plus. Yes, that's right.
Okay, and this is the graph which is coming up. Okay, I'm going to open up a blank template which will show you just the graph, and let's get started here. You know, Elliott Wave, I'm not going to teach you Elliott Wave analysis, listeners, because I guess what you want to hear are the main things. But quite briefly, any up move is supposed to be, if it's in a trending way, should be moving up in 5 waves. And what I see here is a huge move having been completed and this sort of correction coming down here. The way this is coming down suggests to me that this itself is not an impulse wave, the way it's structured. So I'm going to view this as a correction of the previous wave. So let me draw you some Fibonacci lines to show how one could look at this particular rally from here, and then we can draw some conclusions. All right, I'm going to take the significant low and leave it here as the first wave, and then if I consider this as a second wave, it's amazing that over here right on top, you see this end of this move is 1.618 times the first wave. Now, if only we had known, if one had known Elliott Wave analysis and he was looking at this index, he would have definitely gone short here with a small, affordable stop somewhere just above that. Or certainly when it started moving down, he would sell on any small recovery with a stop above that. That's how one would be trading. What I've established now is that we have had 3 big moves, and this is potentially the correcting wave of this rally. Is that clear?
Mm-hmm.
Now I'm going to look at the third wave in particular, which started from here. And if I draw a Fibonacci grid from that, we are approaching the 50% retracement level of this third wave. From here, we got a pretty sharp rally. But if this was going to be a new impulse wave, then we should not come below this. That's your main thing. So any trader who wants to be trading, who's bullish, should be trading with a stop below this. That's the first thing. Now, should we be bullish at this point in time? It depends on a variety of things. Like any analysis, whatever approach you take to the markets, there is no guarantee about the future. One has to take a view and trade with that view. That's how I would recommend a trader to approach the market. Over here, you see all these stops here. They would form the support on the way down. So this area is going to be pretty important for the markets, for the bank index. Having said that, given the view that the Nifty itself is expected to go lower, and the sentiment not being so constructive as of now, I'm not very familiar with the fundamentals affecting the Indian markets because I've been away from India for more than 20 years. I look at it when friends ask me to look at the charts. But I do believe that there is a general mood to leave India and go elsewhere in the current environment. Given that background, we should expect that this decline will carry down a little further, perhaps taking us down to this level. Now let's draw some more ratios and see where it's likely to finish. If you take the whole move from here, the 38.2% is 9481. All right. And if you draw this, the 61.8 is 9060, somewhere there. I would think that this whole thing is likely to come, spend some time here, perhaps go back up and then eventually break down and reach somewhere to this area.
9,000 levels.
9,100 levels at least. That's what it appears to me as very likely. Now, if I take a projection from here and do this and drop it here, the first level, 1.382 times, that's where we found support. Now we are going to correct this first 3-step down move. Let's see where it lands as such. It's already been corrected at 38.2%. Do you see that?
Right. It's already gone.
We have already corrected the first time by 38.2, and then we are coming down like that. We are probably going to, as I said, come down here, go back up. And if that recovery fails to go above this 10,820 levels, for some reason, I'm not saying it's going to stop there, but if it does stop there and comes back down and break this, that will become very bearish. Very bearish for our next target. I'm not saying that the whole thing is going to collapse, but I'm just thinking out loud of what could happen. If this was the end of the move, you see, already it has been there once and second time, and if it fails to break that for a third time, then it will come down and go towards these levels, 9,200 and 8,000, somewhere here. It depends on where it's going to stop. Basically, I'm still playing the bearish theme for this index. I want you to know that these are the critical levels, that we have tested this level twice here on top, all right? And we have some supports here, these tops here.
Right.
So we might spend some time over here between these two lines and then eventually break down. That's most likely what's going to happen. But if it goes above this, then we will rethink. But for the time being, it pays for any trader to buy close to the support and sell over here with a close stop. You should be trading this range for the time being. But if I were you, I would be trading with the downward bias.
What would you be on the upside?
You shouldn't be selling anywhere, on the way up. You should wait for a level close to somewhere where you can spot a good resistance and then sell. See, it's one thing to make. I'm not one of those guys who would say, if this breaks, it goes there. If that breaks, it goes here. Because that anybody can say.
Correct.
What I would say is you sell somewhere close to this level, these bottoms here. Let me move it up a little bit.
About 10.8 to 10, maybe 11, because you would have broken at least something on the way up.
See, you see this first move, sharp move down? first move down. The low for that is 10,915. If you approach that and start coming down, then you should sell immediately.
Got it.
I wouldn't want you to sell anywhere in between because that's a bit of a risky thing on this. On the contrary, if you see it come down slowly, it shouldn't come down very quickly. If it comes down slowly, then you would buy close to the previous lows and keep a stop below that.
Mm-hmm. Yeah, unfortunately, nowadays we seem to be in the habit of moving very, very dramatically. But
yeah, very, very quickly. Yes, that's right. So maybe we should look at an individual stock. Let's go to one of the other stocks.
So DLF.
DLF, all right. DLF. I think that's the one.
DLF.BO, that might work for NS.
Yeah, this is in a very strong bearish mode, and there is no way I would recommend anybody to buy this. Did I show you a screen where there were some analyst recommendations? Let's take a look at that.
Yes. There were some which were, I think, 7 positive.
Yeah. Oh, yeah. This is a screen for DLF, and there are 7 analysts who are saying buy, and 8 saying outperform, and 8 saying hold. I don't know how long these have been like this, or how long these analysts have been asking you to hold on, but clearly this is one stock I would not have even looked at or even thought of buying for quite some time now.
You bet.
Let's go to this chart. It's extremely bearish, and it will take a miracle to turn it around in the short run.
Yeah, it's been consistently going down for over, I think, about 6 months, 4 months now, 4 months since November.
Yeah, from this top, which was, let me see, when would...
It would have been December 2009, 400 plus. Yes, there you go.
This is October 20th, 2009 was the top.
Okay.
October 21st. And that was at 489, somewhere there. So we've been coming down since then, and it's clearly, it's got some more room on the downside. Let's see if we can draw some ratios here. You know, Elliott Wave analysis is a combination of Fibonacci tools as well as wave analysis. You can't separate one from the other. But some people erroneously think that if they know how to draw ratio analysis, they are done with they know wave analysis. It's different. You need to be able to judge for yourself where we are in the big picture. Are we in a bear trend, or are we in a sort of a correction, or in a bull trend? And then draw these ratios to help you pinpoint levels and to confirm your counts. So this was the first move down, and then down a second move, and then we had 100% move down. So there's 3-step down, right?
Mm-hmm.
You see, this first sell-off was equal to the second sell-off. Give or take a few rupees.
Brilliant.
And then you corrected the whole thing by exactly 61%. So anybody who saw this 3-wave move down would know that, and this 3-wave move up would be waiting to just capture. As soon as it starts moving down, he would have been short, or he would have got out of any longs he had. You see, the 61% level here is a very, very important level for wave analysts. Now, if you draw the retracement from this bottom to here, okay, the 61% pullback, that region was also a support.
Right.
So one could have gone long here, or even if he was not willing to go long, he'd be wondering, when should I get out of my longs? Which if I were, for some reason I was unlucky to get long here and bulled up here because somebody told me to buy at these levels, then I'm just looking to get out of it. Where should I get out? The moment he sees the 61% level reached, and if he still thinks it's not done, he would have gotten out of it. Anyway, that's the past, and now we have to look to what's going to happen from here onwards.
One question here, Ramki, is what would you do if it were somebody were playing at the 38% rather than the 61%? Would you give more importance to a 61% move?
Yes. Relatively speaking, the 61.8% pullback is much stronger in all markets. if one had no other tools with him, and if he was playing only with the 61.8% retracement levels, he would be better off than those people who are playing with no clue of technical analysis.
I see.
If you had no knowledge of wave analysis, don't worry. If you see a retracement of 61.8% and if you think the market is going to go up, then at that point you should look for a bounce and then buy. The smallest of bounce should be your first clue that perhaps it's the beginning of a new trend and buy, or the other way around. In a downtrend, on any retracement, you should sell, because at least this level seems to be working time and again for dozens of years. I've been in the markets for nearly 3 decades now, and I've seen it work so many times. So even if you don't have any clue of wave analysis, and it's not an easy thing to learn and understand, even for them, 61.8 is more important than 38.2. 38.2 is also important, but you need to know a lot more about wave structures before you could employ that blindly. But 61.8% is a decent risk in either direction. Now let's take this projection here.
Got it.
Oh, here the 100% level comes at 161.64. That's one thing. Just note this down somewhere, 162 levels, okay?
Got it.
But beyond that, you want to confirm what else can be done. You take from here, the first move down, and the equality from this top comes at 185.94. On balance, I would think this 185, 186 levels is where you should minimum wait. At a minimum, you should wait for this level. That's what I mean.
Got it.
Don't even think of buying the stock anywhere before 186. No matter how bullish you feel about other stocks, this particular stock, you have to defer any thoughts of buying until we reach 186. We can look at it again as we get there. I just want to show you one more move. This move, see, it went up by 50%. The 50% and 61.8% level retracements are very, very important.
Mm-hmm.
See here how quickly it went up. When it went up this sharply after this steep decline, it went up very quickly there. But then it suddenly started moving down again, and that's a clue that this whole thing only allowed people who knew some technical analysis to just get out of their positions here. Some fund managers maybe, they would have just gladly used this rally. It happened very, very quickly, as you can see from this steep rally.
2 days literally.
Yeah, and immediately it just started moving down. So there was some big selling going on here at this level. Now you have 1, 2, 3, 4, and this is the fifth wave. 1, 2, 3, 4. This is the last of the waves, perhaps. And we already said that if this is a correction of this first move up, then this has to be in 3 waves. And we said, you take this. Let me do it from here. 191. I'm just trying to see. I'm trying to bring in some more ratios to see if it sort of concurs with the 186 level. No, it doesn't. So whatever happens up to 186, if I were you, I would not think of buying. And even at 186, I will look at the markets to see whether there are other positive indications, whether there are many other stocks in this sector which are looking to be slightly getting bolder to move up. At that time, I might think of buying this, not before.
Would you care about volume at all?
See, volumes are helpful in saying, are we in the right? Is my count correct? As we go down, as we approach the end of a move, volume should typically taper off. Especially if it's the end of a move and it's going to start moving up, then I would think the volume would decline. Now, in this sharp sell-off here, if that started off with a steep increase in volume, then it would have been very, very bad, especially the first 2 days. That would be a trigger for me. Typically, the third wave is the steepest wave, and that will be normally with the maximum volume. This move here, as well as this move here, which is the third of this whole decline, the volume should have been increasing. I don't have volumes here. This is a new operating system which I'm having at home, so I don't know how to add on volumes. But Let me see. Options, templates, security.
There you go.
Now we have the volumes also incorporated. I can't make out much from there because you see the spike here, Deepak. This spike here is an incorrect spike.
Got it.
And because of that, the scaling on the right has become corrupted.
Got it. So
once I remove the spike from the vision over here, now you see the volumes are showing up. And if I put my cursor here, actually there was more volume when the move started off here rather than on this third wave. So while volumes are useful in confirming which wave you are in, it's not going to really help me to decide whether I should be long or short.
Got it.
So let's go back to the simple blank template. All right. Just for a matter of interest, if you go back here, I want to show you. See, that's a 50% pullback almost here, and then it went to 78.6.
Right.
Don't be fooled by somebody who says that if you draw lines from any point to some other point, you'll always have some sort of retracements available. I mean, all that is, if you want to criticize some approach, one could do that, but one could also make use of these techniques to wait for levels which will offer you low risk trading opportunities and then position for the move.
Yeah, absolutely. I think you're I mean, I because I'm a novice at something like a Elliott Wave, it seems a little bit more alien to me, but obviously there are practitioners who've been with it for a really long time, so there's obviously got to be enough in there to make sense. And I mean, to a large extent, I think when you're speaking of the same figures, it makes sense. So you're working around the 61.8% retracements and trying to work towards the next level, which would be, if you've covered one move, it's the 160% retracements or a projection of it on the other side. You kind of tend to use that as a target, and if you know that in the other direction your stop is much shorter, so you win more when you win, lose less when you lose. That's the way to trade.
Yeah, correctly. The right way to go about it is first determine which wave you're in. If you're in the, let's say, the third wave, then you know that there's going to be a fourth wave and a fifth wave if it's an impulse move. It's a trending move. So if you know that you are in the fourth wave, then you know that there's one more leg to the downside. So you would rather look to sell rather than to buy because you're waiting for it to move down again. Now, if you're an investor who's just going to be playing on the long side, and if you know that you are on the fourth wave, you would wait for the fifth wave to finish before you put in money into the market. And then you would identify using the Fibonacci ratios where the fifth wave might possibly finish, which is what I did with the DLF. The earliest level is 186. So at that point in time, you would revisit the charts, the smaller time frame charts, maybe the hourly charts, and see and look at other studies and read the analyst opinion at that time to look for indications that perhaps we have reached the end of the down move, and then only start investing tentative amounts, smaller amounts, and you can always build up as the move progresses in your direction. Most traders or investors, general public, they just go one day, they read something in the papers or they get some recommendations in an email and they go and immediately put money into the market. And then they find after 1 or 2 rupees up, it just collapses and they find themselves stuck for a long time. That's the thing one should avoid. So let's move on to the other stock which you want to
Tata
discuss.
Steel.
All right. Let me see. I don't even know the symbol.
I think it would have changed to Tata Steel. There you go, right down at the bottom. Disc.bio. Okay.
Ah, this one. All right. That shows how disconnected I am from markets per se in India, but that's of no consequence to our listeners.
No, no, but it's good. It's good. It's good. You could find it fairly easily.
All right. This is the chart for Tata Steel. The first thing to do when you're doing wave analysis is to go to a significant low. After the steep sell-off in 2008, we started off this recovery. So you tend to count the waves from a significant low or high. So I'm going to start from this low. All right. The first wave, second wave, perhaps the third wave here, and then the fourth wave, and then the fifth wave like that. All right. So I do this just to show you how I'm doing it real time. This third wave finished here, I said, and 1.618 times did not even stop it. It was a very big bull market. All right. So I'm going to try 2.618. I'm just showing you these ratios to show you how one could, decide how strong the move was. No.
Wow. 278 perhaps.
4. Let me do 4. See, 4.618 times of that move finished here, near the top. So that was a massive, massive rally. Now, supposing this was itself the end of the third, and we had almost a 50% pullback, and then you had the fifth wave, which is almost equal to the third wave. You see this? I just moved the grid up, right? This, you saw that, Deepak?
Yep. I see
the
it.
Third wave, and then I added to the fourth wave here, leaving out the spike at the bottom. I leave out the spike, and then I see that it goes almost to the end of the move. So we had an equality of the fifth and third, and the third itself was almost an extending wave. So when you have such a move, if you visit wavetimes.com, wavetimes.com, you will see dozens of examples, and there are a few Indian stocks as well. I think Tisco might have also been looked at sometime in the past. I don't know. There are so many charts there. You will see that when there is an extending fifth wave, you normally get a very sharp pullback. And that's what happened. The first time it pulls back to the fourth wave, and then you have a move back up, and typically you will have a retest of that level. That's what normally happens. I just want to quickly go and see before I confirm to you that there is a chance for, let me look at another screen. Yeah. TIS, what are the code?
TISC.bo.
Okay, TISC.bo. Yeah, it certainly tells me that there is more room on the downside for the stock, and therefore I would think that these two lows here.
Yep, the support.
Yeah, if that once that breaks, it could come down quite quickly.
All the way to 450, you think?
It can come back to 438.
Okay, there you go.
So don't be surprised that it comes down to 438 levels. This may, or even lower. This might, shock some people who are traditionally bullish. But if I were to put money in Tata Steel, I would not even think of doing it until we get here. I might miss the opportunity and it might go directly up. But it doesn't matter. I would rather buy a stock at levels where I'm comfortable.
Absolutely.
Just buy it because, even if it starts going up some way, I will still say I'll step aside from the stock. As of now, I think that there is a chance for it to come down here.
Would you say it bounces after that? I mean, or would you more or less look for a bounce?
Yeah, I think if it comes back to 438 and then starts moving up, I would not mind, start investing in the stock from that level onwards. I will start with a small amount, but You see, in a move like this, a very safe level to buy would be here, 412.
Mm-hmm. Yeah, you've
Because
got
that
a
is the
bunch of.
second wave. That's the second wave of the fifth wave. That's a very safe level to buy. This would be asking, asking for
Little too
miracles
much.
to
You're
happen.
talking about
This
50%.
this will be like asking for a miracle, because if you get this, it's a bonus. See, I'm talking of the down move as being a bonus because that will give you levels to buy. But
Mm-hmm.
438 is where you should look for to start. 448 or 438 or 438. Somewhere here in this region, below
Mm-hmm.
448, would be where you should start thinking of buying, not before that. If
Got
you ask the classical Dow theory analysts, they'll start saying that this is a head and shoulder formation in the making.
it.
You
Mm-hmm.
see, but I would be very wary of calling anything a head and shoulder until it breaks the neckline. Where I
Right.
have drawn this line is the neckline. This is the shoulder, head, shoulder. But for this to work, it really has to break this. Until it breaks this support line, it's not a formation which is confirmed. But be aware that there is this formation, and if it works, then the minimum distance will be equal to this move.
Entire move. So you're talking
Yeah.
200%.
That takes you to 429 as an inequality measure.
Yep.
So that ties in with our 438 level.
Okay. Great.
But
Great.
I'm
Great.
not making the projection for 438 based on a potential head and shoulder formation. I'm looking at it because the market is still bearish for the stock. The
Mm-hmm.
overall market is also bearish, and this move down, if this move down has been the completion of the correction, then if this is the third wave up, the third wave should be something like this move down or this move up, the third wave, right?
Mm-hmm.
If the whole move finished the 5-wave move, and if this is a second wave of which corrected the full 5-wave move up, then this move up should be something which is faster than this 5-wave move up, because
Right.
this is the third in that higher degree. But I don't see that. I see it moving sideways here, which is not in keeping with the third wave move up. Therefore, I would conclude that this move up is part of the correction of this first move down. And once the market is decided it's not going to go up, they're going to sell it down as a C wave, it's A, B, C, to complete the second wave correction of this move up. And then we'll have a mega rally.
Mm-hmm.
So when will that rally start? Hopefully from around 438. And if you're lucky, from somewhere lower still.
Brilliant. Brilliant. And would you? So I mean, literally, we look at three stocks, and all of them are showing some kind of bearish move, which is probably right, because when the market's bearish, everything is bearish, right? So, but on this stock particularly, what level on the upside would you say at the double top, say around the 600-700 levels? Would you say that that's the point at which it might say 699, 700? Would that be the point at which you'd say the bearish outlook is reversed, or is no longer applicable?
Okay. Based on Elliott Wave analysis, for me to get bullish on this stock, it really needs to go up very, very fast.
Mm-hmm.
Because only then it's the third wave. If it goes up slowly and breaks this, even if it goes up to 750 or 760 slowly, I would not want to buy it, because it's just going to come down again. Remember, as I said, you should know which wave you're trading.
Absolutely.
And since we have completed 5 waves from bottom to here, 700 levels, and if this was the end of the move, this has to be really fast. It should be something like this mini wave here. You see that from
Mm-hmm.
1, 2, 3? It should be something like that. This third wave, it should be, the whole move up should be of that speed. If you don't get a move of this speed, that means every day you're going to see it higher and higher, then don't buy it. It doesn't matter if you buy it late. If you buy it at 760 also, it doesn't matter, because you need to see it go up very fast. Then you buy it 760, it doesn't matter, because you're going to see a move which is equal to this distance from where 145 to 600. That's more than 500 rupees. You're going to see a huge move up. Yeah.
It's going to be something like around the 950 levels at that point.
Yeah, if this is going to be a bull market, it should go there. So you don't mind buying it at 760 or also, or even 800, provided you know that it is in the third wave. Right now, it doesn't show me that indication. It's telling me that it's going to go
Got it. Got it. That's good, because you got to stop on the upside. If you're ever going to go short, you probably are going to go short. Only
You'd probably sell it.
Yes.
You'd probably sell it on the break below this. But if you have, I mean, if you are an active trader, then let me give you the other level. You might want to sell it at 630 perhaps, which is one of the resistances I have.
It makes sense.
But always the short sellers should beware, because if it starts going up, they will be really badly hurt. At least the long-term buyer long positions could sit it out. If I draw the retracement from the top to this current bottom, you have this 38.2%. You asked me about that level. Is at 628, and 50% is at 644. So either here or 644. No, currently we are at 609 here. That's the last trade. If it goes up to between 628 and 644 and stops there and starts coming down, then you will sell with a stop above the high seen.
Got it.
If you're a fund manager, that's how you should trade it. If you're an individual, then you have to be very, very nimble.
Absolutely.
Now, this is a blown up. I've just made it bigger, so you could even view the retracement of this move down from here to here. All right. You see the 61.8 is 635.
That is if this was the bottom, because
no, here to here. This first sell off.
Okay.
If it goes up, then another thing you can do is you could draw these horizontal lines at 638 and look back and see where you had many points where you had lows. You see this top here, you had 633 as the bottom here. Look back in history and see where there were many levels where it stopped, it turned up or down. The more levels you had, here's one low, here's another low. All right, here's a close. Here there's a close. Here there's a close. So here there's a low, right? So the 635 level, if you look back, you will see there are so many points where you see here.
Right, you got supports because of the closes.
You see the low. Yeah, you see the opening at 635. It opened at 635, and look at this one.
So it could be a turning point.
Yeah, the 635 level seems to be having a lot of action, either the low or the high or the closing level or the opening level. So that should be your key level. If it goes up for some reason and it stops there and starts coming down, then you should set the stop above that.
Got it. Great. That's fantastic. This was, quite an education. I think we will have to revisit the whole concept of the analysis from a chartist point of view. It wouldn't be to say that this is in any way easy, but what would it take, you think, in terms of time for an absolute beginner to an Elliott Wave theory to actually learn enough to be able to trade? How much time?
First thing is, it probably would take him a few months, but as a first introduction, he should do two things. First is he should get hold of a decent book on wave analysis, or he could find lots of resources on the web. He can read those articles. And I would strongly recommend him to visit my blog, not because I have written it, but because there are hundreds of charts there which have been analyzed with wave counts, and they have been made in real time before the moves took place. So you would find where and how I have made some calls, and there are reasons and labels are there. And he could also see how it turned out in the future, because they are all there, and he could see when I have made mistakes and when I have been right, and why we made certain calls there. So that would be sort of an education for him to benchmark with what we are saying now, and perhaps his own learning experience. He typically in a textbook or an article, he would see some hand-drawn diagrams which are ideal. But in the real market, you don't see those ideal formations.
Absolutely right.
So that blog, wavetimes.com, would give you a real time perspective using real charts, how one could use wave analysis for trading profitably and with low risk. So I would recommend that they use that as sort of one of their resources among the various other resources available in the web. And of course, I think your blog, Capital Mind, is also very, very interesting, and it gives lots of interesting insight into the market. So they should look at that for a fundamental perspective on the market. And I think there are many of your other friends who also contribute on Yahoo along with you. You could lead them to those sites. So the trading is a game, is more a mental game, Deepak. It's not just knowing the charts. It's one thing to come up with nice charts and waves. It's another thing to put real money, which is all the reason why I would recommend that one should be very strict about money management. On the one hand, you get these butterflies in your stomach when you have risk money out in the market. The other thing is you should know when to get out of it, and you should not just freeze.
Absolutely.
So technical analysis would help you to get a handle on the markets, but at the end of it, you have to pull the trigger at the right time and not wait and wait and wait. So if you have identified a level, you should commit money there, and you should know when you are wrong and get out of it. And if it moves in your favor, you should know that you should wait for your targets to be reached, or at least a certain multiple of the amount of risk is seen in the market before you take it out. Normally what one does is the moment he sees a couple of rupees, he wants to take the profit. But if it goes against him for 10 rupees, he just waits.
I agree. It's a little bit of a loss aversion theory, right? Always.
Yeah. So this is a learning process throughout one's life, and even I make these mistakes. So I would expect everybody else also to be making the same types of mistakes. So look at this. This is still Tata Steel. A simple trend line. You connect these two bottoms and extend it, and it stopped here. So maybe when it comes here, if it stops here at 584 and starts going up, immediately you buy with a stop at 580.
Right.
Straight line. This is not wave analysis, but as
pure
simple
trend,
as that.
Trend line.
Line.
There you go. Yeah, of course. Yeah.
And if you draw a Fibonacci retracement of the whole thing, and if it comes here around this time at 644, okay, and at this time, if it gets here, even after going down, if it comes back here or over here at some time in the future, then you should think of using these techniques. At 38.2%, 628, it says here. If it reaches this point, when at the same time there's a declining trend line, if it connects, if you're lucky to see that, then you should take a position, right? You cannot just keep watching it.
Yeah, so you're basically saying that it follows these. On a basic trend line analysis, you would say if it bounces off the lower trend line, you'd kind of wait for it to get to probably stay within this triangle, at least create a target at the upper level of the triangle, and maybe that at this point that even coincides with the 50% retracement.
Well, first of all, I wouldn't call this a triangle, although it looks like that from, at first glance it looks like a triangle, but this is not a triangle from an Elliott wave point of view. What I was trying to illustrate to you is, if you use Fibonacci ratios, and if that coincides with a trend line, then that gives you an added signal that maybe that Fibonacci ratio will work. That is what I was trying to show you.
I see. More like a double confirmation of the same
correct.
concept.
Yeah. So if over here, the 50% level seemed to be close to this support line. So one might have used this area to buy with a stop below the support line. The support line you would have drawn from here, right? You would have extended from here into time. You wouldn't know that it's going to hold, but the 50% level is 582, and you would have bought there with a stop below this support at 576. You would have probably kept a stop at 570, because it confirms that 50. Here you have one support, Here's another support. This sort of held, it went through intraday and came back and closed above it. So that 50% level is sort of holding. You would again try it because of this supporting trend line. Correct? And you would have bought
Right.
it for another fourth time. Perhaps you would buy it with a stop below the trend line. And the next day it touched the trend line but bounced straight back up. So what I want people to do is to combine wave analysis with Fibonacci ratios and simple trend lines and identify low risk levels and take positions with close enough stops.
Brilliant.
That's the way to make money in the markets.
There you go. Thanks. That's a wonderful way to state it. Thanks a ton, Ramki. It was absolutely brilliant talking to you. And I know we've had some technical glitches. I must apologize for them because most of them were at my end. And I'd love to, I would love to talk some more. We will speak some more on more stocks, as I hope, as our viewers also hope, I suppose, that markets at some point will recover, and then the analysis will give them a better point to enter into stocks. At this point, it seems more like the entry levels of stocks itself are far below our current levels. But it's always good to know, because you don't know what to do. At least you now know what to do.
Let us use this as a first sort of introduction to wave analysis, and we'll probably have some more of these sessions going forward.
Absolutely.
And it'll be a pleasure to be able to talk to our audience again through your channel, Deepak. Thank you once again for inviting me to be on this program, and I wish you and the rest of the people out there the very best of luck in the market.
Thanks so much, Ramki. It's wonderful to have you, and look forward to catching up with you again.
Sure.
That was Ramki for you, ladies and gentlemen. Please leave us your comments. We would love to hear what you have to say.